You can think of capital budgeting as an NPV IRR chapter. Everything in this chapter revolves around calculation of NPV and IRR. NPV essentially is a discounted value of future cash flows, and what is IRR? IRR is the rate which sets NPV to zero. Let's expand on this further. How do you calculate the NPV of a project? Essentially, the cash flow is in three stages. The first is your initial outlay, as in what is the initial cost which you have to incur to start the project. Then before the terminal year, which means if let's say the duration of project is 10 years, so till the 9th year, starting from year 1, so 1 to 9 is your operational years. In these operational years, you will have some operational cash flow, and then you discount it to the present value, which will give you present value for all those operational cash flows. In the last year, terminal year, so let's say if a project is of 10 years, the last would be 10th year. So in the 10th year, you will have some kind of an operational cash flow, as well as you will sell off your assets and gain some kind of a return of that. So combine both these cash flow and discount it again to your present. This will give you the net present value if you sum up all these cash flows. And obviously you will have to get into the details of the calculations and be very precise with what you are considering for the cash flows, because somewhere in the operational cash flow calculation you will encounter depreciation. If you just change the method of calculating depreciation, your NPV will change. If you move on to the next stage of this chapter, you will have to evaluate projects. So a simple way to evaluate projects would be to just compare the NPVs. But what if the projects are of unequal lives, which means there's a project which is of 2 years and there's a project which is of 10 years. So a simple NPV comparison here would not make sense, right? Because you can only compare two projects which are of almost the same duration. So how do you get around this? So there are two ways of it. First is the LCM way, which is a classic mathematical solution, which means if let's say there's a project of 2 years and there's a project of 3 years, what is the LCM? It's 6. Just convert the 2-year project to 6-year project. How? By multiplying this project 3 times. So you'll have 3 into project 1 of 6 years. And project 2 is of 3 years. So if you multiply it by 2, you will get 2 projects of 3 years each, and in total 6 years. So now we have like comparison. 6 years project, 6 years project. Just compare the NPV. Few people might find that this is extra headache, so they might want to get to a shortcut method. So a shortcut method would be the EAA method. So how do we get that EAA? Now the idea here is first calculate the NPV for both the projects and then find out what is the annuity, the fixed annuity, which could replace the cash flows of the project, giving the same NPV. So now you again have a like-to-like comparison if you consider the EAA. Then you move on to a section of capital rationing, in which let's say you have 5-6 projects and you want to allocate a big corpus of your money into few of the projects, depending upon which projects are more profitable. So in that way, first will be you check the NPV of all these projects and you try to maximize the NPV. A good way to check how you're maximizing the NPV would be to check the PI values. So using NPV and PI, you can understand which projects to put your money into. And at times, you might find a situation in which you are not able to use all of your money in the projects, which is fine. So you will find situations in the CFA textbook where they are giving examples that I had to invest, let's say $100 million, and I'm not able to invest all of it because I don't have sufficient profitable projects. Now there's also a discussion on real options. Real options meaning, as the name suggests, that your future project decisions depend upon some contingent event which will happen in future. So as options are always contingent on something, even real options here is essentially contingent on a future event. So you can read up about this in the CFA text. There is also a discussion of sensitivity, scenario analysis, and Monte Carlo simulation. So what is sensitivity? You're changing one input and how does your NPV change in response to that. That is the sensitivity of your NPV with respect to that input. Now, what will be the scenario analysis? So scenario analysis essentially is creating different scenarios and then trying to find out what will be the NPV in all these scenarios. Scenarios would be changing a combination of inputs. Let's say you have 5 inputs. You give different values for the 5 inputs in 3 cases or 3 scenarios and then compute the NPV for these 3 scenarios, and then you will have an NPV scenario analysis. Now you can also have a Monte Carlo simulation done. We assume some kind of a probability distribution for input. In response to that, we have a probability distribution for the NPV of the project. With this, we end corporate issuers.